What's up guys? So this is going to be the first video in a series here that will hopefully give you a good base and foundation to your learning process. A lot of the information that is out there, it's presented in a very chaotic manner. It's really hard to understand what you should be studying, what you shouldn't be studying, what information is important, what information is not important at all, and it's really hard to find structure to this process. So that's going to be the main goal here. We're going to try to start from base one, assuming that you don't really know anything about the markets, and work from there. So obviously over here, this is just a chart of Bitcoin. So we can see we have these green candlesticks, these red candlesticks. Obviously we know that green means up, red means down. But this chart right here means absolutely nothing to us whatsoever if we don't understand how the market works and the key fundamental concepts behind what's going on here. So to start things off, we're going to start talking about auction theory. And it's pretty important to understand that the market is an auction composed of buyers and sellers, similar to the real estate market or a car auction. Buyers and sellers are always fighting to find fair value, and they want to do business at fair value. And basically this is just another way of saying that the market is always hunting for liquidity. The main goal of the market is to provide liquidity, and whenever price can gravitate to an area of so-called fair value, where buyers and sellers agree on price and are willing to do business, that is when liquidity arrives, because transactions are being placed, buyers are buying, sellers are selling, and that's pretty much the main basis of how the market functions. It's pretty much just a non-stop hunt for liquidity every single day. And since this auction process is manned by humans, in exchange it expresses human behavior. So we can really break this behavior into 6 main things that we call market development. You have a current price, you have a reference price that is too high, you have a reference price that is too low, a reoccurring price area, any change in any of those 4 things, and then the relationship of these elements to the others. And this is a non-stop, ever-changing process. So things are always changing and always moving. And another thing that's important to understand is that the market is always presenting an opportunity to someone at any time. And there's 3 main time frames that the market is going to work off here. And the first one's going to be the main time frame, which would be the market imposed time frame, which is pretty much just the operating hours of the exchange. The second time frame that you're looking at here is the individual time frame of the buyer and seller, how long they are looking to hold onto a trade, hold onto an asset. And then the third one that you have is going to be the window of opportunity, and basically that's going to be the moment that forces an individual to react to price or whatever it may be because of the opportunity that's provided within the market. So getting a grasp on all of those things and really understanding them is probably the most important thing that you can do. Looking at indicators, looking at the chart, drawing triangles on the chart, it means absolutely nothing. You can train a monkey to draw triangles on the chart if you wanted to. If you don't understand what's happening, then all of that stuff is absolutely worthless, and it does absolutely nothing for you. So understanding these key concepts is extremely, extremely important, and I have some resources that I'm going to share with you guys to kind of help you go over that, and you can kind of consider it homework if you want to. The first one is a book by Peter Steidlmayer, and it's called Steidlmayer on Markets. And you can find this online most likely. It's provided to free for all the Discord members, so if you're looking for a structured way to learn, feel free to join the private server. But regardless of any of that, you could probably find it online. You could buy it if you want. But it's a very, very important book, and really all beginners should be reading it. Because today you see a lot of the flashy things where people want to draw all these indicators on charts and do all of that, but what you also have to understand is that 90% of traders in this market fail. So if 90% are doing the same thing, obviously it's not something that works, because if everyone was making money in the market, then how could the market be efficient? That would mean that there's not anyone losing money. So where could the money possibly come from that people are making? So yeah, it's really easy to get caught up in all those flashy things, putting 20 indicators on your chart and thinking that's helping you out, but the truth just is it's not. It's doing more harm than it is good. First thing you need to do is understand the key concepts of the market, why it works, why it's profitable for the institutions to act the way that they do, and always be hunting liquidity, and just really getting a grasp on the key concepts here. So the next thing I'm going to talk about here is kind of the purpose of the market and why it works. So to understand the market, it is necessary to find its purpose. You have to understand what the purpose is. And the real purpose of any market is to distribute a product efficiently, which is also its economic function. That's really the base of it and what it is. Any number of people trading among themselves without this purpose would not be serving society, and the marketplace would be doomed to failure. You would not have an efficient market, and yeah, the process would just not be going so smoothly. It's important to understand that even though everything looks super hectic from the outside, it's actually a very organized process, and the market works in a very organized way, despite how it looks from, or how it would look to a beginner. So getting back to the aspect of human emotions kind of controlling the market, it's important that we have a structured way to see those emotions and how they play out, and the way that we're going to do that is through market profile, which is pretty similar to volume profile, which you can see over here. It's somewhat similar, but it's also a little bit different, and Steidlmayer on markets will teach you all about that. For the homework for this one, I'll put everything in the description as well, but I want you guys to read chapter 8 of that book specifically. I want you guys to start there. Don't start from the beginning. Go to chapter 8 and also chapter 9 and read both of those chapters, and pretty much it's going to talk more in depth about what I'm talking about here today. And it's really super important that these concepts are grasped appropriately. So I know that the information I've given you guys here is probably super overwhelming, and I don't want to make this video too long because I don't want to give you guys too much to chew here and just end up confusing you more. So starting for right now, just go download or buy Steidlmayer on the markets, and read chapter 8 and 9, and really make sure that you're understanding the information that's there. We'll get more into market profile and all of that good stuff in the coming episodes, and we'll start getting more advanced and advanced as we go. But as I said, for right now, it's super important to understand auction theory and understand why the market works the way that it does and make sense of it in your brain. I know if you don't really know anything about it, it can be kind of hard to grasp, but it's super, super important. So yeah, that'll be it for the first episode here. I hope you guys enjoyed it, and as I said, I'll leave everything in the description as far as what you should be reading and what you should be looking over. But other than that, you guys enjoy the rest of your day, and I'll catch you guys on the next episode.